This is an analysis from Alpha Business Media. So, the IMF is calling this a new era for the global economy. But what does that actually mean for 2025? Today, we're going to break that down. First, we'll assess this new landscape of slower growth. Then, we'll identify the critical geopolitical landmines that are causing it. And finally, we'll pinpoint the lighthouses of opportunity that these huge shifts are creating for investors. So, let's start with the big picture. When you look at what the major institutions are saying, there's a clear consensus. The story is one of subdued, kind of uneven growth. But, and this is the important part, right below the surface of that agreement, there's a profound sense of uncertainty. And it becomes really obvious when you start to compare the actual forecasts. Okay, take a look at this. You have the IMF, the World Bank, the OECD, all clustered pretty tightly, right? They're all projecting growth somewhere between 2.7 and 3.1%. But then you see Fitch, way down there forecasting less than 2%. That's a huge spread. Now, that divergence isn't just about different economic models. It signals a serious disagreement about one major underlying geopolitical risk. And that pessimistic forecast from Fitch, they point the finger at one factor for this potential slowdown: the escalation of global trade wars. So you see, this stops being just an economic story, and it becomes a geopolitical one. Which brings us right to the heart of the matter, the geopolitical crucible, because this economic slowdown, it isn't happening in a vacuum. It's being actively shaped by several geopolitical landmines, and the biggest one of all is rising protectionism. It's not just some background noise, it's absolutely front and center. I mean, just think about this finding from the World Economic Forum. A full 100%, every single chief economist they surveyed expects trade policies and shifting alliances to weaken the global economy. That level of agreement is just staggering. It tells you the primary risk factor has moved away from external shocks and is now the direct consequence of political decisions. And believe me, this isn't just sentiment. The impact is real and it's measurable. These tariffs are acting like a direct brake on the economy. The IMF, for example, cut its global growth forecast by a huge 0.8 percentage points specifically because of these measures. But this goes beyond just slowing growth. It's fundamentally fragmenting global trade, and it's forcing companies into this new reality of strategic de-risking just to protect their supply chains. Now, on top of those headline trade disputes, regional instability is adding another really dangerous layer of risk that investors just can't afford to ignore. The world is, quite simply, becoming a more volatile place. The map of risk now pretty much spans the globe. In Ukraine, the conflict continues to put European energy security on a knife edge. In the Middle East, tensions threaten global trade through the vital Suez Canal. Across Asia, disputes create massive uncertainty for semiconductor supply chains. And in Africa, instability could disrupt the supply of minerals that are critical for our future. The scale of this instability is truly historic. 59. According to analysis from Wellington Management, that's the number of active military conflicts happening worldwide right now. To put that in perspective, it's the highest level recorded since the Second World War. Let that sink in for a moment. Okay, so that brings us to the billion-dollar question, right? In a world of slowing growth and a minefield of geopolitical risks, where on earth can an investor find a lighthouse? Where are the pockets of opportunity that are actually being forged in all this volatility? Well, starting with the largest market, U.S. stocks, you see a clear divide. You have heavyweights like Goldman Sachs and BlackRock staying bullish. But then you have institutions like HSBC and UBS that are advising caution and diversification. This split really highlights a key strategic decision point for investors. But there's a lot more agreement when you look past the broad markets and focus on specific durable trends. 3 areas in particular really stand out. First, technology, with AI being hailed as a potential megaforce that could reignite productivity growth across the whole economy. Second is healthcare, which is being propelled by the powerful duo of longevity and the integration of AI in research and treatment. And third, the energy transition. The urgent, non-negotiable need for grid resilience and electrification is creating massive, long-term investment opportunities. And these opportunities, they're also redrawing the map of economic gravity. Certain emerging markets are proving to be remarkably resilient. You have India, powered by the durable engine of its own domestic demand. You have Mexico, benefiting directly from the nearshoring boom as supply chains reorient. And you have nations across Southeast Asia that are thriving as connector economies, basically building the new trade links for our fragmenting world. So, it all comes down to this question. In this new era of transformation, is your portfolio actually built to navigate all this turbulence, or is it still anchored in the world of yesterday?
As we've seen, the global economy of 2025 is being defined by slower growth and bigger risks. But that very same turbulence is carving out distinct opportunities. Navigating this successfully is going to demand a focus on quality, on diversification, and on a deep understanding of these new geopolitical undercurrents that are reshaping our world.
This has been an analysis from Alpha Business Media.
This has been an analysis from Alpha Business Media.